Hello and welcome to this budget special. I am Rima. With me is Nigel, and markets crashed on budget day. The key indices were down 2%. The Nifty at that 24,800 mark. The Sensex selling off nearly 1,500 points. And of course, the biggest culprit was the sentiment dampener was the increase in STT on the derivatives market.
Well, that's right, Rima. Let's do a quick wrap, though, of what took place in today's trading session. Yes, as you said, the Nifty was down, and you did have the Nifty Bank as well that was under pressure in today's trading session. A very, very difficult day of trade. As you can see, all the indices, the Nifty ending down close to around 500 points. At one point of time, we were down close to around 700 points. The biggest hit really today came in terms of sentiment. No one was factoring in, or at least the buzz was not very, very loud, that an STT hike could come about. That's precisely what the Finance Minister did announce. And because of that, you had all these market players, whether you're looking at Angel One, BSE, CDSL, all of them took a sharp knock in today's trading session. There was an expectation that the defense-related names, they'll see a higher allocation. To be fair, actually, the allocation is quite high. However, those stocks had already run up in anticipation, and that's why those stocks had come in for profit-taking. BEL, Bharat Dynamics, as well as HAL, all of them sharply lower in today's trading session. Bharat Dynamics, in fact, had put on a good amount of weight getting into this event, and all that got sold into, so those stocks were under pressure. The other problem was the gross market borrowing. That number came higher than expected at around 17 lakh crore, or the street was bracing for a number of around 16 to around 16.5 lakh crore. And because of that, the PSU banking names, after seeing a good run up in the last few trading sessions, they did come in for profit taking. Even Big Boy, SBI did see some selling. PNB as well did end lower in today's trade. The other couple of names, though, did pretty well. So let's highlight a couple of winners. Data center plays. There was a bit of a booster shot that came in for them. So Anant Raj, E2E Networks. Remember, these are stocks that have already seen a sharp correction. You have NetWeb Technologies as well. That was higher. Let's get some of those stocks running for you on the screen. And Orient Pro, some kind of play with regard to data center. We'll have to see how it actually plays out. For the time being, though, these stocks did pretty well. Precious metal stocks, though, they did correct over the weekend. And today, some of those stocks that are direct play in terms of precious metals, they came in for profit taking. MCX was down close to around 10% in trade. You had Muthoot Finance as well. That was lower because, that in the entire up move that we saw on gold, Muthoot Finance as well did play out. And Hindustan Zinc, Vedanta just sold a % stake in the company at much higher levels. And today, post that correction that we saw on silver, well, those stocks, in fact, were lower. The AMS companies, though, there was a hike in terms of the PLI component, and because of that, those stocks did well. So Amber, Keynes, both of them, they outperformed in today's trading session. Moving to some of those IT sector names, there was some kind of relief that came because of the harbor turnover threshold for IT services. That was increased. Some kind of booster shot coming in with simplification of buyback rules as well. That's what pushed these stocks up. So you had Wipro that was higher in today's trading session. Finally, there was a fear that there's going to be a hike in gold import duty. Didn't come about, so you had the jewelers that actually did pretty well. Titan came off the highs, so that stock was trading in the green. And in today's market, a stock trading in the green actually was a bit of a rarity. And Kalyan Jewelers as well, after the kind of selling that we've seen, that stock as well moved up. The other space that actually did see some kind of a bounce from the lows was the OMCs, because the excise duty hike on oil hasn't really been announced. We'll have to see how the arithmetic works. But HPCL, after CNBC TV 18, got some clarification on that front. That stock as well ended higher. But Rima, what a day of trade, right? No one would have thought. Came in with some optimism that maybe there'll be something that'll be done to spur sentiment, to get the FIs back. That didn't come about. The STT hike, that's something that's prolonged the pain, actually, from an equity market perspective.
Completely spooked the market, and this is the biggest single-day fall that we've seen on a budget day in the last 6 years. In fact, let's go across to Yash to talk about what is the biggest overhang on the market, this increase in the STT on derivatives. Yash.
Well, Rima, just yesterday there were certain counters from where there was a very faint noise around STT increase which was being heard. Of course, yesterday it was only a chatter. And today it played out exactly as per the script. The government, through its budget, hiking the securities transaction tax or STT on equity options to 0.15% from 0.1%. That's a hike of about 50% in STT on equity options, and on equity futures, STT being hiked from 0.15% to 0.15% from 0.05%. That's a 150% hike in STT on equity futures. Now, an important clarification where the market was into some bit of confusion in the early announcement time, and that was that this STT is only on equity options and futures and not on commodity transactions. So that is an important clarification which came about from experts as the day went, but indeed a very steep hike when it comes to the securities transaction tax, which is expected to hit very hard as far as those high frequency trade, those multiple transactions are concerned as far as futures and options is concerned. From the listed player point of view, of course, there are certain players on the market which are severely impacted, and that showed in the stock price as well. For Angel One, FNO transactions contribute about 44% of their revenue. BSE, it contributes about 55% of their revenue. NSE, it contributes about 70% of their revenue. These numbers are as on FY25, and the change in taxation is expected to impact this side of the revenue directly. There was a very interesting tweet which came from Nitin Kamath, I'm sorry, and that was projected STT collection for FY25-26 was 78,000 crores. The government was falling short by about 25%. This coming about will take care of that deficit, hopefully, in the coming financial year.
Okay, all right. Thanks a lot for that. Yash, well, let's focus on the other sector, defense. That was on the offensive the last few trading sessions. Today, they actually got what they wanted, but the stocks did sell off. Ria joins in to break down the numbers for us. Ria, take it away.
Well, yes, the government this time around has announced a total defence budget of 7.85 lakh crores. Now, compare this to last year's budget of 6.81 lakh crores. It's an increase of roughly 15%. So, the expectations on this front range from 10 to 15%. So, this is at the top end of the expectations. The defence expenditure has been announced at 5.95 lakh crore rupees for the year, up 21% compared to last year's budget. Defence capital allocation has also been announced at 2.31 lakh crores versus 1.92 lakh crores in FY26, and this is also an increase of roughly 20% compared to last year, also in line with the expectations that the street was working with. There has also been a 24% increase in the budget for defence modernisation, which is a bit positive. Apart from this, they have also allocated roughly rupees 63,734 crores for aircraft and aero engines for defence, which is a 31% increase compared to last year's outlay. Now, in terms of the market reaction, the Nifty Defence Index ended roughly 5.4% lower today, recovering from its lows of 7 to 8%. And in fact, at one point of the trading session earlier, before the budget was announced, it was up by roughly 2% earlier in the session. Now, the street seems to be disappointed by the fact that there were no separate announcements or schemes that were announced for certain segments like drones, UAVs, electronic warfare, defense electronics, missiles, even for arms and ammunition or for indigenization as a whole. So that is where the street seems to be disappointed. But overall, this was a very healthy increase in the capital allocation as well as for the overall defense budget.
Thank you very much for that. It's over to Ekta now for more on what came out on the biopharma.
Well, yes, I'll start with, biopharma Shakti, which was announced. So it's around a 10,000 crore biopharma scheme which was launched, which is aimed to make India a biopharma hub, build domestic biologics manufacturing. So there are 3 new NIPER institutes which are planned, 7 existing NIPER institutes which will be upgraded, and 1,000 plus accredited clinical trial sites which are proposed as well. It is a sentiment positive for the sector. Biocon, Dr. Reddy, Sun Pharma, Lupin, Glenmark, just to name a few. In terms of hospitals and diagnostics, medical tourism push. So 5 regional medical hubs are planned. It will be a public-private partnership model. Integrated healthcare complexes are proposed as well. Listed beneficiaries include the likes of Apollo, Fortis, Max Healthcare, Dr. Lal's, Metropolis, all of these stocks in focus. But remember, while this is a positive, the execution will be something that the street will be watching for in terms of all of these announcements and the material impact eventually on the earnings as well.
Okay, got it. Thanks, Ekta, for that. Hopping across to Upasana, she brings us some good news with regard to a few of those companies from the EMS space that actually did well. Upasana, tell us.
Well, under the ECMS scheme, the investment outlay has been increased from 22,919 crore to 40,000 crore. Mind you that the ECMS scheme was first notified in April 2025 with a budget outlay of 22,919 crore for a period of 6 years, with the aim to build $500 billion electronic manufacturing ecosystem by 2030-31. Now, we are assessing a positive impact on EMS players given the high allocation, which means more approvals for the companies. Now, if you look at the latest development in October 2025, MEIT has approved the first batch of 7 projects under ECMS involving manufacturing of copper-clad PCBs and even camera modules. Now, the approved players so far include Keynes Tech, which has received approvals in all the categories that they have applied. Sirma SGS and Amber have also got approvals for multi-layer board. And now lastly, coming to Dixon, the approvals for display application and even optical transceiver is awaited in the upcoming tranches of ECMS approvals. So all in all, certainly a positive news for EMS space.
Thank you very much for that. And on that note, we'll slip into a short break. On the other side, Feroz Aziz of Anand Rathi Wealth and Rajashri Sabnavis of Grant Thornton Advisory will be joining in. Hello and welcome. You're still tuned into this special budget programming on CNBC TV 18. A lot of announcements and taxation, of course, that is one important aspect to discuss. What it means for you as an investor, how does it impact your profits, how does it impact you on a daily basis? Let's get to that and understand more on the impact. Joining us today are Feroz Aziz of Anand Rathi Wealth, and we also have Rajshri Sabnavis joining us. She's from Grant Thornton, Bharat. Feroz and Rajshri, thank you so much for joining in. Of course, we've been talking about that hike in securities transaction tax, the change in buyback taxes. Before we discuss those in greater detail, what stood out for you in the budget when it comes to personal finance and personal taxes? Rajshri, let me begin with you, and then I'll come across to you, Feroz.
Sure. Thanks. Thanks for having me on this panel. I think if one were to look at from a market standpoint, I would segregate into small investors, small and retail investors, and large corporates and the traders. Every effort has been made in this budget to essentially protect the small shareholders, and you've seen some of the announcements. In fact, they go to the fundamental. The second is, when we talk about investors, I think the serious investors would clearly look at the actual fundamental growth and the growth trajectory that we as a country are at. And some of the announcements that has been made, keeping in mind the global uncertainty and the headwind, tailwind, whatever you may refer to, I think that's something which we should be considering. And from a tax standpoint, the promise was made in terms of not too many changes, simplifying and ensuring that the smaller taxpayers face less compliance burden. I think every effort has been made in this budget to walk the talk.
Okay, take that
so
point.
If you want examples, I can quickly touch upon it, but I guess it's up to you.
No, of course. I'll come back to you on that example quickly. Rajshri, let me go across to Feroz. Feroz, what stood out for you in the budget from a personal tax perspective? We did see securities transaction tax on F&O getting hiked. Do you think that would impact arbitrage funds and ultimately the returns for an investor there?
Yes, Sonal. First, let me touch upon the direct tax. I think one thing, if you're a viewer and if you're watching and if you're in the old tax regime, it is apparent to naked eye that you should not swim against the tide. There are about 74%, 73% of them have now moved to the new tax regime. If you are a part of the 26%, I think this budget is the last nail in the coffin for the old tax regime. And you should try and move to the new one at ASAP and not get into these small deductions, because there was no tampering there. And the new tax regime is so lucrative that you shouldn't miss it out. That's point one. Point two, when it comes to STT, I think there are large implications, different kinds of implication of the STT. One is there's a key message. That's not just an STT change. If you read the para in the proposed bill, you will see it as we are trying to discourage the futures and options trading platform and the higher volumes which are there. It's not just about tax collection. How much tax do we collect in STD? 48,000 crores, if I'm not wrong. That will not materially change because of this tax change. It is a message that we don't want trading mindset capital market like the US. We want a more investor-friendly market than a trader-friendly market. That's why you see the traders are spoofed and they want to quit today and bring down Nifty by about 600 points. So it is investor-friendly, trader-unfriendly. That's one message. The second thing, if you see the nuance or the fine print, says that interest expense will not be allowed to set off against the dividend if you have borrowed to invest in the market. Again, leveraged market positions are also discouraged. So that's where I would like to stop. But there are larger implications to the futures and options on the derivative side. Since I manage a derivative treasury for a couple of decades, I probably touch upon a little in greater detail at that point.
Okay, I'll come to you on that in just a bit. Rajshri, you wanted to give an example on how smaller changes have been made that could have a bigger impact. If you can touch upon that in a greater detail, and the buyback tax that has been changed. Can you explain that to us? How does it change for retail investors? Because for corporate promoters and non-corporate promoters, we have different rates. What does it mean for a retail investor?
Sure. I guess, until last year, what they had said is when buyback tax was introduced, of course, and when the change was brought in, they had said it would be taxed as dividend income. okay, in the hands of the investor. They have in fact cleared that, and they made it uniform and said everything will now be subject to tax as capital gains. The only differentiation that they made is because the promoters are in a position to influence these decisions, there is an attempt, and there is clearly, that's what the announcement is, which said that the promoters will not only, there is an additional tax that is applicable to promoters as well. Now, of course, the rate of tax would differ depending on whether the promoter is an individual or corporate, and accordingly, there is an additional tax that has been imposed. That's one. Second, if you see, for the first time, if you see again the small shareholders. So here again, my smaller shareholders, very clear, it's capital gains. Second attempt has been made in terms of filing of these Form 15F and 15G. This is again small shareholders, mind you. Earlier, you would have to run to every bank, every company and submit these forms. Now what they're saying is all these smaller shareholders have to do is submit it to the depository, and the depository will then in turn submit it to the company. So here, cost of compliance and the headache of going across to so many companies is kind of cut down to a large extent. So that is a second move. Third, again, there is an attempt to, from a tax standpoint, if you are a small shareholder, again, there are certain filings which you can make. They have kind of made changes to the timelines within which you can actually go and revise a return. If you want to declare certain foreign assets, again, there is a revision that's been made. So all in all, it is more bringing in stability and also looking at the small retail shareholders and trying to protect, in a way, from the market vagaries, which if a few months ago, the entire STT, I'm not surprised, with the rate increase, because there was data that was available in the public domain, which showed how much of money the retail investors had lost on account of trading in futures and options.
9 out of 10 investors, or traders, I would say the word, had lost money in F&O trading. Take that point, and that is something that the ministry had also alluded to, the particular study. Firoz, you wanted to touch upon the derivatives bit, also wanted to understand some of the exemptions or the TCS rate cuts which have come by on LRS payments that are made. I just wanted to understand, how are some of these factors going to affect your personal finances? You did mention it's time to move to new tax regime. Anything else that you think was a big takeaway from the budget this time?
Yes, so let's see. First, let me touch upon that 15H and 15G submission to depositories is, of course, something which is very good. But I was surprised when I read the fine print that it's applicable from financial year 27-28 and not the one which is coming by. So that's one thing which you should keep a note of. The relief to small shareholders and senior citizens with that form submitting to depositories is not applicable for the subsequent financial year, but 1 year later. That was surprising. That's one thing I thought fine print should be highlighted. Coming to the question of, from a personal tax standpoint, what stands out is certainly the fact that the buyback tax, I personally think it is beyond the point which I'm going to make is a nuanced point and not visible to naked eye. It is not about tax coming down for a retail shareholder alone. If the tax comes down from dividend tax, which was a flat rate, to 12.5% in the hands of the tax owner, there are two things which happen. One is the frequency with which buybacks were happening had become near zero. Now, when buybacks happen in the market, there's a kind of a market buoyancy which happens. Now, for example, if I'm a listed company, if I'm making profits like if my company's profits projected are 375 crores for this year, and if with God's grace, if I'm able to meet that guidance, the first question which the board will ask is how much to be paid back and by what form. If it is dividend, it does not impact market prices, but if it is buyback, it creates a buoyancy to the price. That company is extinguishing their shares by buying it back, increasing the promoter stake if it does not participate. So it is a great, positive, buoyant sentiment for the NSE small cap 250 companies, especially because today the balance sheets are reasonably large. The reserves are too many. And that's why I think is the most important impact. Not the tax, but the frequency of buybacks, creating market liquidity for an FII, for a retail guy, tax efficiently.
Got it. Take that point. I have a lot more questions. We are completely out of time, so we'll take this forward some other day, I would say tomorrow, because we have a working day, a Monday tomorrow. But thank you so much for your initial thoughts, Feroz and Rajshri. It was a pleasure speaking with you. And with that, we'll take your leave on this edition of Budget Programming. But of course, more will continue on the other side.
माननीय वित्त मंत्री श्रीमती निर्मला सीतारमन जी.
We are inspired by three kartavya. Our first kartavya is to accelerate and sustain economic growth. Our second kartavya is to fulfill aspirations of our people and build their capacity, making them strong partners in India's path to prosperity. Our third kartavya, aligned with our vision of Sabka Saath, Sabka Vikas.
Good evening and thank you for joining this CNBC TV 18 special broadcast on Budget Day. I'm Ritu Singh and here are the headlines. Finance Minister Nirmala Sitharaman's 9th budget keeps an eye on the fiscal deficit glide path, even as it focuses on driving growth by increasing exports and attracting stable long-term investments, promises to sustain the momentum of structural reforms, strengthen the financial sector and support building cutting-edge technologies at home. In a surprise move, the Finance Minister proposes hiking securities transaction taxes on equity futures and options contracts. STT on futures is to be hiked by 150% and by 50% on options. The move rattles the stock markets. The Sensex and Nifty reverse early gains to post the biggest budget day decline in 6 years. Finance Minister projects nominal GDP to grow at 10% in the next fiscal, hikes capital expenditure outlay by 9% to 12.2 lakh crore rupees. Documents show the government missed last year's target by 3%. Finance Minister looks to spend more to shore up India's defence capabilities. The budget proposes hiking defence capex outlay by 21% to 5.9 lakh crore rupees. The budget for defence modernisation is up 24%. The government sticks to the path of fiscal consolidation. Fiscal deficit target for the fiscal is projected at 4.4%. The FY27 target stands at 4.3%. The debt to GDP ratio is projected to decline from 56.1% to 55.6%. A sharp hike in government borrowing. The budget projects gross borrowing of 17.2 lakh crore rupees. This is 18% higher than the current fiscal year's estimate of 14.6 lakh crore rupees. The government projects net tax collections at 28.6 lakh crore rupees. This is slightly lower than budget estimates last year. Collections in FY26 missed the budget estimate by 1.6 lakh crore rupees. The government accepts the recommendations of the 16th Finance Commission. States will continue to get a 41% share of overall tax revenues. As expected, there are no changes to personal income tax, but the budget proposes measures to ease compliance and cut down on litigation, like more time to revise tax returns without penalties. Also proposes lowering tax collected as source on foreign travel to a flat 2%. TCS on money sent abroad for educational or medical expenses to also be at 2%. The Finance Minister moves to further curtail any improper use of buybacks, proposes to tax buyback for all types of shareholders as capital gains, also proposes introducing an additional buyback tax on promoters to disincentivize the misuse of tax arbitrage, says the tax will make the effective tax rate 22% for corporate promoters and 30% for non-corporate promoters. Finance Minister looks to help the government companies raise funds. Budget proposes accelerating the recycling of significant real estate assets of CPSEs through dedicated REITs. The Finance Minister moves to offset the impact of 50% US tariffs, allocates 40,000 crore rupees to boost electronic manufacturing, announces 10,000 crores dedicated fund for MSMEs, and also plans to set up mega textile parks, eases export norms for seafood and leather sectors. The Finance Minister looks to tap more foreign investment for India's AI ecosystem. The budget proposes a 20-year tax holiday to any foreign company that provides cloud services using data centers in India, but the holiday can be availed only if this is done through an Indian reseller entity. Also proposes providing a safe harbor of 15% on the cost of the company providing the service is a related entity. The Finance Minister acknowledges the role of emerging orange economy in nation building. Budget 2026 proposes supporting the Indian Institute of Creative Technologies in Mumbai to nurture talent in India's fast-growing animation, visual effects, and gaming comics industries. Also proposes setting up content creator labs across 15,000 secondary schools and 500 colleges. A modest capex hike, more firepower for India's defence arsenal, and a tax shocker for the stock markets. Finance Minister Nirmala Sitharaman's 9th consecutive budget is aimed at providing a thrust to manufacturing and offset the impact of 50% US tariffs. Let's quickly take you through some of the top highlights. First of all, the stock markets were rattled after the Finance Minister proposed hiking the Securities Transaction Tax or STT on equity futures and option contracts. The market saw their biggest budget day fall in 6 years. The Finance Minister added more firepower to India's defence arsenal. Defence allocation has been hiked by 21% to 5.9 lakh crore rupees. The budget for defence modernisation is up 24% overall. Capex also saw a modest growth of 9%. As expected, there are no changes to personal income tax, but the budget did propose measures to ease compliance and cut down on litigation, like more time to revise tax returns without penalties. Here are the key snippets of the Finance Minister's minute budget speech.
In the interest of minority shareholders, I propose to tax buyback for all types of shareholders as capital gains. However, to disincentivize misuse of tax arbitrage, promoters will pay an additional buyback tax. This will make effective tax 22% for corporate promoters. For non-corporate promoters, the effective tax will be 30%. I propose to raise the STT on futures to 0.05% from the present 0.02%. STT on options premium and exercise of options are both proposed to be raised to 0.15% from the present rate of 0.1% and 0.125% respectively.
ये बजट भारत की वैश्विक भूमिका को नए सिरे से सशक्त करता है। भारत के 140 करोड़ नागरिक फास्टेस्ट ग्रोइंग इकोनॉमी बनकर ही संतुष्ट नहीं है। हम जल्द से जल्द दुनिया की तीसरी सबसे बड़ी अर्थव्यवस्था बनना चाहते हैं।
All right, let's go across to Shireen Bhan, who's in conversation with some special guests to decode Budget 2026. Shireen, over to you.
Well, thanks very much. Yes, those are some of the key budget highlights that we're presenting to you here on CNBC TV 18, your budget headquarters. Let's bring in more big voices. As we've been pointing out, while the focus and the attention has been on the union budget, another very important document being tabled today, and that is the report of the 16th Finance Commission. Joining us now is a member of the 16th Finance Commission, Mr. Manoj Panda. The chairman, of course, of the Finance Commission is Dr. Arvind Panagaria. Also with us, former member of the CBDT, Akhilesh Ranjan. Mr. Panda and Mr. Ranjan, many thanks for joining us. Mr. Panda, to you first. The big headline, of course, is that devolution number, status quo there, 41%, as was expected. But take us through the rationale behind that and some of the other important measures that the Finance Commission has proposed in its recommendations. Mr. Panda, can you hear? Well, we'll come to that in just a second, but let's go across to Jyotiraditya Scindia in conversation with my colleague Ashpit Kumar. Here's the Minister of Telecom.
To get an understanding, to help us unpack what that translates into, I have with me the Honourable Minister, Mr. Jyotiraditya Scindia. Mr. Scindia, thank you so much for taking our time. Firstly, the big message that the Finance Minister is looking to send out via this message, there was a very clear thrust towards infrastructure spend. There was a very clear thrust towards newer technologies. Your key takeaways?
So, the Prime Minister and the Finance Minister both have set the tone for Viksit Bharat 2047. There has been a tremendous amount of momentum over the last 12 years from 2014-15 till date. The economy is on a very, very strong footing. With that in mind, setting ourselves up for ensuring greater momentum on our route to 2047. The areas that we're talking about, sustained economic growth. Sure. We're talking about a Vikas model that looks at assimilation of every single citizen and unlocks their potential to contribute to that growth, and a concept of fulfilling aspirations of people. And if you look at the sustained thrust on capital expenditure as well as infrastructure, in addition to that, a couple of the main themes that are coming out. The first, ease of doing business for every single person across this country. Second, to be able to unlock new potential sectors for India, whether that's the orange economy, whether that is AI, whether that is urbanization, whether that is tourism, across the board. And I'm very glad to note that there has been a very important stress on fiscal performance. Fiscal deficit is now under control. We are looking at 4.4% for this year, 4.3% for the next year. We have maintained a very tight grip on inflation. For the 3 quarters, it's at only 1.7%. And along with that, for my 2 ministries, both for telecom and for donor, a very healthy increase in capex capability, both for telecom and for donor. The Northeast has got special emphasis in this budget, both from a urbanization point of view and the 4,000 e-buses to the...
Well, that is the Telecom Minister Jyotiraditya Scindia in conversation with Ashmit Kumar. Let's go across to the former CBDT member Akhilesh Ranjan. Mr. Ranjan, many thanks for joining us here. As expected, no changes on personal income tax, but what was not expected was that STT hike. What you had said very clearly was you didn't anticipate any changes on LTCG, none of that coming through. Changes on safe harbor, specifically for IT services. On balance, on the tax side, Mr. Ranjan, how would you rate the budget and the measures taken?
Shri, thanks for having me here. Well, the STT was a bit of a shocker. There are some very good things which have been announced. You remember I was talking about preventing litigation from happening. And I think the measures that have been announced for safe harbor and transfer pricing, various other things on the APA program, advanced pricing agreement, these are steps which are very, very, very welcome. And I'm sure they will cut down on the litigation to a large extent. There are also a host of measures which are building trust and confidence in the taxpayers, the decriminalizing provisions, the provisions where where tax defaults are now not criminal really offenses in that sense. I think that's a very, very good move. So those are very well received. The only thing is I'm a bit surprised at the STT increase. As I had said on that day, I think the STT is no longer a legitimate tax. So, and then to increase it is a bit of very strange. I'm told that the reason is to curb excessive speculation. I'm not so sure whether this sort of an increase in STT does anything to curb speculation amongst the investors. It might just hit the margins of large players who are active in the futures and options market. But let's see, I'm not an expert on this, so it doesn't really impact the market to that extent.
Yes, the market is going to have to live with that. But Mr. Ranjan, a couple of other issues that I want to point out to you. And we've seen a lot of actually in the fine print, a lot of retrospective a lot of amendments coming in to retrospectively react to court orders, especially when it comes to the Din Amendment and so on and so forth. What do you make of that?
Well, actually, I think we should view that in a positive light. I think there are attempts to try and resolve issues which are creating a lot of uncertainty in the minds of taxpayers. Both of these major retrospective amendments you're talking about, they concern an issue which is going on in the courts for a very long time. And it's not a very substantive issue. It's a technical issue, but it is throwing the whole system into confusion. So I think it's good that that the view has been made clear, that the law has been resolved, clarified, and resolved. And I think we should be viewed in that light, not as a retrospective, as something coming as a surprise, but something done to really remove ambiguities and to prevent litigation from happening or stop the litigation from happening. So I think that we should look at it in that way.
That's a welcome move, you're saying. I'll come back to you in just a second, but let me get Mr. Manoj Panda in, member of the 16th Finance Commission. As I was pointing out, the budget, of course, in itself a big event, but it's also the 16th Finance Commission's recommendations that have been tabled today and accepted by the government. Mr. Panda, many thanks for joining us. The headline that we've got, of course, is on the devolution, which stays at 41%, and that is the formula that the Finance Commission has stuck with. But if I could ask you to explain to us the rationale behind sticking with that number and some of the key recommendations that the Finance Commission has made this time around.
Yeah, thank you. Basically, the 41, 42% has continued for the last two commissions. And particularly during the 14th commission, there was a big rise in the devolution from 32 to 42. 15th broadly continued that, except for some adjustment for Jammu and Kashmir being made union territories. So, and our overall assessment is that the central financial position is as good or as bad as that of those of the states. And when we talk of a developed India or movement towards that, the center cannot be made fiscally weak. They have to be fiscally as strong as those of the states. The responsibility of a developed India contributing more towards GDP lies both with the center as well as with the states. So because of that, we decided that it is not the time to change the 41%. We should stick to it, and center should feel as much comfortable as in the past couple of years.
Right. Mr. Panda, some of the other key recommendations, to do with grants, to do perhaps with centrally sponsored schemes, etc. We haven't been able to go through the fine print of the Finance Commission's recommendations yet. We've been busy with the budget. If you can take us through some of the key recommendations you've made.
Yeah, no, the centrally sponsored schemes, that doesn't come under the purview of the Finance Commission. But what also comes apart from the 41% is how the 41% will be divided among each of the states. And that's a major part of the recommendation. What we have done this time is basically introduce a new variable called contribution to GDP. And it is given 10% weight by taking out some weight from area, some from the forest, and also tax effort. Now, the rationale for that is the states must be nudged towards their own contributions to GDP. If we see the states' developments, some of them are developing fairly well, but some of them are not able to catch up. They must be nudged to catch up with the rest, at least to some minimum level. And that is the major reason why we have gone for contributions to GDP. Along with that,
which means what? Mr. Panda, just for the benefit of all our viewers, which means that the states that are doing better, what is the impact on them, and the states that are contributing less to GDP, what is the impact on them?
Oh, I think the overall impact will be, as a percentage of devolution, it will not be large. It will be only 0.2, 0.3% of the total. For most of the states, for one or two states, it might go to 0.4%. But the developed states were always complaining that they are being penalized for their contributions to national growth, contributions to national revenue. And that is the reason why we thought it is time to change the direction, at least nominally, so that even if there is a small change, that will send a message. The other major...
So the finance... yeah, go ahead, sir.
Yeah, the other major recommendation is, earlier where states were being given quite large revenue deficit grants to begin with, and they were being asked to reduce it substantially or even eliminate by the end of the Finance Commission's recommendation period, at the end of the 5th year. Now, our analysis says that, the normative assessment that the Finance Commissions used to do and the actual revenue deficit that actually took place, they are very widely different. And a cycle of high deficit slowly going down to low deficit by the 5th year, and again coming back to high deficit, that cycle continued for the last 3-4 commissions. And last year, the 15th Finance Commission's last year recommendation, it brought it down to as low as 13,000 crores only for 6 or 7 states. All other states, they did not get any revenue deficit. We have decided to recommend that no state should get any revenue deficit during our award period. Now it is for the government to take a decision on that. I think two other recommendations
measure that no state should have a revenue deficit. What does that mean, sir? How do you ensure that?
No, we didn't. We recommended that no states should get it.
Okay.
The 15th Finance Commission, they had awarded to 6 states 13,000 crores, bringing it down from more than 1 lakh crores. Then we thought it is almost negligible now. It is time to eliminate the deficit altogether. And revenue deficit, if it is eliminated, then that will give incentive for investment. And in the process, again, states can contribute towards GDP.
Well, Mr. Panda, we will have to go through the fine print of your recommendations and then perhaps have a more nuanced conversation with you. But thanks so much for joining us with your first take on the recommendations made by the Finance Commission. Mr. Ranjan, a quick final word from you on the proposal for that tax-free proposal that the Finance Minister has announced for data centers to be able to service foreign companies out of India. 22-year tax-free period. What do you make of that?
Yes, actually, this is in view of the new data center policy, which is coming out from the Ministry of Information Technology. It is an attempt really to assuage the apprehensions of the foreign companies which are going to spend billions of dollars in setting up these data centers. One apprehension of these companies was that since they are using a server installed in India, their income that they earn out overseas might become taxable in India to some extent, and I think this exemption, this outright exemption, of course, it is not something that would have been very clear in the law. The taxability itself was in doubt, but then there was an apprehension, and I think the government has tried to just remove that apprehension very clearly by giving a very blanket sort of exemption. The only condition being that if you are earning income by providing services to Indian residents, then that must go to an Indian company, and the server must be under the control of the Indian company. I think it's a measure which is trying to give tax certainty again. So one more measure in the area of certainty, which I think is quite welcome.
A welcome move there, Mr. Ranjan. We will, of course, continue to speak with you through the course of the next few days as we unravel more of the fine print. But don't go anywhere, sir. Don't go anywhere to our viewers. So thank you, Mr. Ranjan, for joining us. We're going to take a quick break and return with a lot more. Stay tuned to CNBC TV 18. We're back in a moment. Reform, not rhetoric. Ambition, not ambivalence. With that, Finance Minister Nirmala Sitharaman rose to present her record-breaking 9th budget, holding out hope for India in the medium to long term and ensuring that some of the pain points, some of the friction areas are addressed, be it on taxation or predictability and certainty. What didn't go down well was the hike as far as the STT on options and futures were concerned. That weighed on market sentiment, but that apart, there is plenty of continuity that Finance Minister Nirmala Sitharaman has stuck to, whether it is on the fiscal glide path or it is on the reform agenda. Joining me now is the top team from FICCI to take us through what they make of Budget 2026. With us, Anand Goenka, Puneet Dalmia, Harshpati Singhania, Shubhrakant Panda and Sandeep Samani. Gentlemen, many thanks for joining us. Ananta, I'll start by talking to you. The big focus you expected was manufacturing. There's plenty there for manufacturing, but equally, there is plenty there for services. In fact, the Niti Aayog CEO BVR Subramaniam telling me this is a services budget. Your take on Budget 2026?
I think the budget focuses on growth, inclusivity and youth. I think the most exciting part is that it is a budget of continuity and stability, and the focus on Reform Express continues, focus on infrastructure has continued and only increased, and finally on the manufacturing side, a very good balance of future industries where we need to be indispensable and present industries which are very employment focused, such as textiles, leather, apparel. So a very well balanced budget which takes into account a macroeconomic or a macro view into the future, as well as the micros of taking care of the initial challenges that we are seeing.
Puneet Dalmia, CapEx number is now out 12.2 lakh crore rupees, and it goes in line with what the government has been saying, that look, we can't keep doing double-digit kind of CapEx numbers year after year. On balance, what do you take away from what the government has said on CapEx, the larger infrastructure thrust in the budget?
Well, I think I think India is the most credible large economy growth story in the world today, and it is because it offers certainty in an era of unprecedented global chaos and uncertainty. I think this is driven by the fact that there is continuity on infrastructure spend, as you said, 12 lakh crores. I think there is also a very stable tax regime, and there is also more ease of compliance on regulation. So I think we are seeing all of this play out as a larger vision of how to create a Viksit Bharat by 2047 and an Atmanirbhar Bharat. So I think the building blocks keep getting put in place every year, and it strengthens the foundation to create a vision, and we move forward one step every year. So there's a 9th budget for the Honorable Finance Minister, which is a record, and it's the first budget from the Kartavya Bhavan. And as I was saying, that it's from a bhav of kartavya, which is good intentions, lead to good policies, will lead to good outcomes. And I think they've also said that it will be a budget which will continue growth, 7% GDP growth, build capacity for the future to fulfill aspirations of India. And also, finally, it is Sabka Saath, Sabka Vikas, for all families, for all communities and for all regions. So apart from the big picture, there is a lot of micro detailing on which sectors, which areas, what is their strengths, and it allocates capital very thoughtfully to ensure that we can leverage strengths of each area and each community to further the vision that the Honorable Prime Minister has created.
Yes, absolutely. To take forward the point that you were making, whether it was MSMEs, whether it's a 10,000 crore rupee outlay, the electronic component manufacturing scheme, where the outlay has now been enhanced to 40,000 crores, or it is benefits, basic customs duty benefits to the nuclear power sector, and so on and so forth. Mr. Singhania, if you were to look at the fine print and the minutiae, what stands out for you in terms of impact?
I think it's a very important budget from the point of view that we are operating from a space where our debt to GDP ratio is coming down continuously. So there is certainty, there is clarity in the direction, and that is very important. In today's turmoil globally, there are very few large economies
and those particularly, I mean, nobody is growing at the rate that we are growing, which have these kinds of numbers. So this is very important, and as the Finance Minister herself said, this provides fiscal space. So this is extremely important to look at. Along with this, the Finance Minister has also talked about trying to invite foreign investments into India, be they through the data centers, be they through even people of Indian origin living overseas, because I think the rupee depreciation is also predicated on the fact that we are seeing large capital outflows. So besides looking at the domestic side growth alone, we are trying to invite foreign capital, which to me is a welcome move.
Shubhakant Panda, plenty there for the medical space, medical hubs for high-speed rail, defense corridors, and of course tourism as well. But on balance, what do you believe the budget is likely to deliver on in the near term? The medium to long term is a different story altogether.
Well, I would expect that, the focus as always has to be on execution because announcements are great, but in all fairness, I must also mention that this government and this finance minister has had a sharp focus on execution, as has been seen from previous budgets. Shireen, the point I wanted to add here is I think what stood out for me was the multiple references to ease of living and many proposals which were connected, to that concept. So I think it's a citizen-centric budget which is very welcome. And also from an inclusivity point of view, not just as Puneet mentioned about, opportunities and resources for all sections of society, but the fact that, even within the emphasis on manufacturing, there is also, specific schemes and support for MSMEs, which is very important because that's the real job creation machine in the country, in any economy for that matter. And I think that focus will stand us in very good stead.
Okay, yes, whole bunch of sectors there being mentioned by the finance minister. And the defense, while she didn't talk about it in her speech, the defense allocation has seen an increase B2B of about 21%. So that's been a significant change there and a significant capital allocation for the government as well. But Anand Goenka, coming back to you now, specifically, for the electronic manufacturing sector, because that was something that you had spoken about. She didn't announce a park, but, the component manufacturing scheme has got a significant uptick. There was a park announcement, but that was more to do with textiles and technical textiles to be specific. But, the point that you were making that continue to accelerate growth for that sector, enough done?
Yes, so on the electronic manufacturing scheme, she has only increased the outlay, which is exemplifies enough focus on EMS. She has also added the semiconductor mission to continue with ISM 2.0. So both put together, there's a fair amount of focus on semiconductor sector.
Yes, and ISM 2.0, the allocation was not provided in the budget, and that's probably because it is waiting for cabinet approval. So we'll probably see an allocation coming in for ISM 2.0 later. But Puneet, coming back to you, high-speed rail, freight corridors, container shipping, an allocation for that as well, ship repair, civil aviation sector, components being exempt from basic customs duty. So a lot in the infrastructure and allied infrastructure spaces linked to manufacturing also being mentioned there by the finance minister.
Look, India is building massive physical infrastructure and digital infrastructure, and this is intended to create inclusion and to boost productivity. And I think we are moving from just a domestic growth economy to being globally more competitive as an economy. So I think this will ensure all this investment in infrastructure will ensure that our logistics costs come down, mobility increases, people are more connected, and it just unlocks productivity across people, across various segments of society. So I think this is a very welcome move, and the beauty is it's done with a long-term vision. And the execution momentum just continues every year. So, and it's also done very thoughtfully. So the capital allocation is not, done, it's done with a lot of micro detailing which cities should be connected where, what hubs should be created depending upon the strength of that area. So I think the capital allocation is also very thoughtful. And lastly, some of the investments in softer aspects of infrastructure like healthcare, education, tourism, etc. is being done on a challenge basis. So they are also very mindful of, getting states to compete with each other so that efficiencies can be unlocked. So I think I really like the fact that this will create global competitiveness for India and create inclusion because more people can get connected and be more mobile.
Right. Sandeep Samani, let me get your take on what you liked in the budget, the big highlights for you.
So I think for industry, the downside is always when there is a policy change suddenly. And I think this finance minister laid out a roadmap a few years ago, and she has stuck to the roadmap, improving on the roadmap year on year. So there is no unpleasant surprise. Focus continues to be on making India more competitive, which was one of her opening statements. And also I think the important thing is continued focus on infrastructure. Infrastructure will help us, better infrastructure will always help India improve its logistics costs, where we are higher than the rest of the world, therefore improving competitiveness. Also a lot of focus on capital goods, SOPs being given to various industries to promote capital goods manufacturing in India. Labor-intensive industries being given SOPs, textiles, fisheries, shoes, leather. So I think focus in the right areas to use the money in a more efficient manner that the government has allocated. I was pleased to see the disinvestment budget being significantly raised to some 80,000 crores. So all the right focuses, including MSMEs, which are job creating. First time the government has said that they will create a 10,000 crore fund to actually invest equity in MSMEs, and I think that's a very bold step and a very good step. It improves in scaling up and giving the financial muscle to MSMEs that can really grow into larger companies. So overall, I think a good, directionally very good budget in terms of hitting all the sweet spots and making sure that we continue to focus on growth in India in a very volatile environment. Global environment is extremely volatile and uncertain. So India is I would say an island of paradise in a very turbulent world.
It is a turbulent world, and it's turbulent for our stock markets today as well. We've seen the markets being very volatile through the course of the budget day. But gentlemen, we will of course continue to speak with you over the course of the next few weeks and months as many of these announcements come to fruition by way of execution. But today, for your first reactions post the Finance Minister's budget, thanks very much for joining us here on CNBC TV 18. We're going to take a quick break. There's plenty more that's coming up as we highlight the fine print of Budget 2026. Stay with us.
Welcome back to this special broadcast on Budget 2026. Now, markets reversed their early gains to post the biggest budget day decline that we've seen in 6 years. Nigel D'Souza has all the market action and is joining in now. Nigel, what a tough Saturday or Sunday for the markets it's been.
A very, very difficult day of trade. As you can see, all the indices, the Nifty ending down close to around 500 points. At one point of time, we were down close to around 700 points. The biggest hit really today came in terms of sentiment. No one was factoring in, or at least the buzz was not very, very loud, that an STT hike could come about. That's precisely what the finance minister did announce. And because of that, you had all these market players, whether you're looking at Angel One, BSE, CDSL, all of them took a sharp knock in today's trading session. There was an expectation that the defense-related names, they'll see a higher allocation. To be fair, actually, the allocation is quite high. However, those stocks had already run up in anticipation, and that's why those stocks had come in for profit-taking. BEL, Bharat Dynamics, as well as HAL, all of them sharply lower in today's trading session. Bharat Dynamics, in fact, had put on a good amount of weight getting into this event, and all that got sold into, so those stocks were under pressure. The other problem was the gross market borrowing. That number came higher than expected at around 17 lakh crore, or the street was bracing for a number of around 16 to around 16.5 lakh crore. And because of that, the PSU banking names, after seeing a good run up in the last few trading sessions, they did come in for profit taking. Even big boy, SBI did see some selling. PNB as well did end lower in today's trade. The other couple of names, though, did pretty well. So let's highlight a couple of winners. Data center plays. There was a bit of a booster shot that came in for them. So Anant Raj, E2E Networks. Remember, these are stocks that have already seen a sharp correction. You have NetWeb Technologies as well. That was higher. Let's get some of those stocks running for you on the screen. And Orient Pro, some kind of play with regard to data center. We'll have to see how it actually plays out. For the time being, though, these stocks did pretty well. Precious metal stocks, though, they did correct over the weekend. And today, some of those stocks that are direct play in terms of precious metals, they came in for profit taking. MCX was down close to around 10% in trade. You had Muthoot Finance as well. That was lower because, that in the entire up move that we saw on gold, Muthoot Finance as well did play out. And Hindustan Zinc, Vedanta just sold a % stake in the company at much higher levels. And today, post that correction that we saw on silver, well, those stocks, in fact, were lower. The AMS companies, though, there was a hike in terms of the PLI component, and because of that, those stocks did well. So Amber, Keynes, both of them, they outperformed in today's trading session. Moving to some of those IT sector names, there was some kind of relief that came because of the harbor turnover threshold for IT services. That was increased. Some kind of booster shot coming in with simplification of buyback rules as well. That's what pushed these stocks up. So you had Wipro that was higher in today's trading session.
Nigel, thanks very much for taking us through that action. Now, in what was a surprise move, the finance minister proposed hiking the securities transaction tax, or STT, on equity futures and option contracts. Now, the STT on futures will be hiked by 150% and by 50% on options. Here's what market experts made of that surprising move.
STT increases beyond expectations of the market. But in some sense, it is the syntax of the market. 9 out of 10 retail investors were losing money. The benefits was mostly going to the HFTs. Undoubtedly, government had to take some step. We can only pay that STT and capital gain. STT was introduced in lieu of capital gain. With increased STT, the Honorable Finance Minister may look to reconsider capital gains taxation.
Don't go by the immediate reaction. Markets are spooked because of the STT, but I think overall, what she mentioned in the first paragraph, reform over rhetoric, action over ambivalence, and people over populism, I think I would have summarized in a similar manner, but she herself said before presenting the budget. So I'm in a glide path towards lower debt to GDP, continued focus on infrastructure, which includes digital, physical, social, continue to, the ease of doing business, improving the quality of life to make the most of the demographic dividend. I think all of them are structurally positive, and particularly on the buyback, because all of us, we have been discussing that the cash is getting piled up in the corporate balance sheet. So either they do the capex, which I think some of the tax incentives on data center and few other things should spur that.
FIs are definitely out of the market today. So real impact of this will be seen tomorrow in terms of how are they thinking about this particular thing, because a lot of marginal trades will become unviable. So the high frequency traders, for them it will be unviable, a lot of it will be unviable. Second, there are a lot of products, arbitrage products, where a lot of money is there. Those will become unviable, and hence there will be a lot of redemption in those products whenever this new regime comes in. So the market will get less leveraged and less liquid. So the impact on the market will be a little more bearish because of this particular provision.
The increase on SGT on derivatives, I look at it as a move from the government to oriental and align people towards trading and investing long term in equities. Today, the equity SGT will be lower than F&O SGT, which encourages them to get into the equities market. That is totally in alignment with the capital formation requirement of Viksit Bharat. The SGT increase, this is not the first time it has happened. Every time when it happens, the reaction is exactly like what you said. The market feels worried and concerned whether it will impact volumes, will impact revenues, etc. India is a growing economy and fast growing in a big way. And in that process, what we have always seen is the market growth is so much, and the depth of the market grows so much. The initial concerns go away soon, and the market starts developing.
Now, Budget 2026 has also proposed a 20-year tax holiday to any foreign company that is providing cloud services using data centers in India. Rachna Dhanrajani is here with the details of that and the significance of this move. Rachna?
That's right. Budget 2026 puts data centers firmly in focus with clear tax incentives aimed at pulling global cloud companies into India. The Finance Minister has announced a tax holiday till 2047 for foreign companies offering global cloud services from data centers located in India. Any services sold to Indian businesses, however, will be routed through an Indian reseller and they will be taxed locally. But to reduce tax uncertainty, the government has fixed a 15% safe harbor margin for related party data center services. This is a move aimed at cutting long-running transfer pricing disputes for global cloud firms. But there's also a supply chain push. Non-residents warehousing electronic components in bonded warehouses will be taxed on a 2% profit margin, translating into an effective tax of about 0.7%. So who benefits globally? Well, large cloud providers running global workloads from India stand to gain definitely. This includes Amazon Web Services, Microsoft Azure, and Google Cloud. Now, global electronics manufacturers using bonded warehousing in India also benefit, as do the multinational tech firms looking for long-term tax certainty till 2047. On the Indian side, however, several companies are positioned as key partners given that they have a joint venture. First up is Adani Enterprises, who's in a joint venture with EdgeConneX under Adani Connex. There's Reliance Industries, who's building large hyperscale data centers, campuses in partnership with Brookfield and Digital Realty. Then there's Bharti Airtel. Through Nextra Data, this works with global cloud and enterprise clients. Then there's also Tata Communications that's providing data centers and cloud infrastructure to global enterprises while being located in India. And then there's ST Telemedia Global Data Centers that runs a large India presence and is backed by the parent company that also has ownership from KKR. So put together, these measures show how the budget is using tax certainty, lower logistics costs and clear rules to position India as a base for global cloud and data center operations. Back to you.
All right, Rachna, thanks very much for taking us through that. Now we'll move on because the budget also saw a slew of initiatives to boost the textile and the seafood industries. But are these measures going to help offset the impact of US tariffs? That's the question we're asking, and Shilpa Ranipeta has the answer. Shilpa, are these measures enough to offset a 50% potential tariff hike?
Well, that's the hope. But let's look at what the announcements were. Now, the government has announced a series of relief measures for India's textile, leather and seafood industries. All labor-intensive sectors, all currently under pressure due to high US tariffs and weak global demand. Now, starting with seafood. Now, seafood, the duty-free import limit for inputs used in seafood processing, that's been raised from 1% to 3% of last year's export value. This means that exporters can now import more essential materials without paying customs duty, helping them cut costs. Now, in another big move, fish caught by Indian vessels in India's EEZ and on high seas will now be duty-free. And if that fish is landed at a foreign port, that will be treated as an export, allowing fishermen and companies to legally sell abroad and access export benefits. Now, the government also says that safeguards will be put in place to prevent misuse of this. Next, leather and footwear exporters. Now, the duty-free import benefit, earlier available only for full footwear exports, has now also been extended to the shoe upper exports. That's the upper layer of the shoe as well, and this lowers costs for a key segment of the supply chain. Also, exporters of leather goods, garments and footwear will now get 1 full year to ship their products, up from earlier 6-month deadline, and that gives them more breathing room as orders slow down amid delays because of the entire tariff situation. Now, on the textile front, the government has announced an integrated push. This includes new schemes covering fiber, self-reliance, cluster modernization, job creation, handlooms and handicrafts, sustainable textiles and a lot more, including mega textile parks and a new initiative that aims to strengthen khadi, handloom and village industries. Now, with a focus on branded training and global market access is also there. Now, why this support now? Because US tariff shock has been hitting these sectors hard. The US accounts for nearly 30% of India's apparel and textile exports, and these after a 50% tariff, have been in a difficult place, especially places like Tirupur. They have been warning of factory shutdowns as shipments to the US have fallen by over 50% in Q3. CRISIL, in fact, has also said that it expects the US tariffs to result in India's leather industry's revenue falling by about 10 to 12% in FY26. And in the seafood industry, US makes up about 35% of exports, and shipments have already fallen 25%, with new orders in the future completely drying up jobs as export-heavy sectors navigate one of their toughest global trade environments in years. Back to you.
All right, Shilpa, thanks very much. Plenty in the budget to tackle that 50% potential tariff. Thanks very much for that. Now, the budget also had some announcements for the states that are heading to elections this year. Sandhya Gora has more on that. Sandhya, from Assam to West Bengal, Tamil Nadu to Kerala, all of them found a mention in the budget.
Yes, and as anticipated by political experts, like past instances, this year's budget also focused on poll-bound states. Like earlier years, the budget combined both symbolism and policy announcements. Finance Minister Nirmala Sitharaman presented her 9th union budget today. This time, she wore a traditional Kanjivaram sari. In 2021, when West Bengal, Tamil Nadu, Assam and Kerala along with Puducherry went to the polls, the Finance Minister quoted Rabindranath Tagore in her budget speech and wore West Bengal's Lal Pat sari. In 2025, the Bihar election year, she wore a Madhubani sari from the state, and this time a Kanjivaram sari from Tamil Nadu. Like 2021, 2023, 2024, 2025, this year too is electorally crucial, with assembly elections due in West Bengal, Tamil Nadu, Kerala, Assam and Puducherry. The BJP has been keen to expand its footprint in these states, particularly West Bengal, Tamil Nadu and Kerala. Against this backdrop, FM Nirmala Sitharaman made multiple announcements today, ranging from special infrastructure development in Tier 2 and Tier 3 cities, including temple towns, to a tourism push and a strong focus on the textile sector. In her 9th budget speech today, the Finance Minister proposed support for mineral-rich states such as Odisha, Kerala and Tamil Nadu to promote the mining of rare earths and to develop a dedicated rare earth corridor in these states. She laid particular emphasis on the textile sector, announcing Samarth 2.0 to upgrade textile skilling. She also proposed an integrated program for textile sector, including a national fiber scheme, a textile employment scheme, a national handloom and handicraft scheme, and the setting up of mega textile parks. Tamil Nadu contributes over 26% to India's overall textile exports, while West Bengal exports around 12% of its handloom and textile products. The Finance Minister also announced an outlay of 20,000 crore rupees for urban infrastructure development in Tier 2 and Tier 3 cities, including temple towns. Poll-bound Tamil Nadu and Assam, both known for their historic and culturally significant temples, are expected to benefit from this push. She further announced trekking and hiking trails, bird watching and turtle trails, as well as special wildlife tourism trails in multiple states, including Assam, Tamil Nadu and Kerala. The Finance Minister also announced high-speed train corridors on 7 routes, including Hyderabad to Chennai, Chennai to Bengaluru and Varanasi to Siliguri.
All right, interesting there. Kanjivaram finds, to be the pick of the Finance Minister over a Mekla, over a Kasav. Thanks very much, Sandhya, for putting that interesting thought into perspective. On that note, we're going to wrap up this special broadcast. But stay with us. More news and updates will continue right here on CNBC TV 18.
माननीय वित्त मंत्री श्रीमती निर्मला सीतारमन जी.
We are inspired by three kartavya. Our first kartavya is to accelerate and sustain economic growth. Our second kartavya is to fulfill aspirations of our people and build their capacity, making them strong partners in India's path to prosperity. Our third kartavya, aligned with our vision of Sabka Saath, Sabka Vikas.
Item number 1.
Good evening and thanks for joining CNBC TV 18's special broadcast on Budget Day. I am Archana Solanki. Here are the headlines we're tracking. Finance Minister Nirmala Sitharaman's ninth budget keeps an eye on the fiscal deficit glide path, even as it focuses on driving growth by increasing exports and attracting stable long-term investments. Promises to sustain the momentum of structural reforms, strengthen the financial sector and support building cutting-edge technology at home. In a surprise move, the Finance Minister proposes hiking securities transaction taxes on equity futures and options contracts. STT on futures is to be hiked by 150% and by 50% on options. The move rattles the stock market. Sensex and Nifty reverse early gains to post the biggest budget day decline in 6 years. Finance Minister projects a nominal GDP to grow at 10% in the next fiscal, hikes capital expenditure outlay by 9% to 12.2 lakh crore rupees. Documents show the government missed last year's target by 3%. Finance Minister looks to spend more to shore up India's defence capabilities. Budget proposes hiking defence capex outlay by 21% to 5.9 lakh crore rupees. The budget for defence modernisation is up 24%. Government sticks to the path of fiscal consolidation. Fiscal deficit target for this fiscal projected at 4.4%. FY27 target stands at 4.3%. The debt to GDP ratio projected to decline from 56.1% to 55.6%. A sharp hike in government borrowing. Budget projects gross borrowing of 17.2 lakh crore rupees. This is 18% higher the current fiscal year's estimate of 14.6 lakh crores. Government projects a net tax collections at 28.6 lakh crore rupees. This is slightly lower than the budget estimates last year. Collections in FY26 missed the budget estimate by 1.6 lakh crore rupees. Government accepts the recommendation of the 16th Finance Commission. States will continue to get a 41% share of overall tax revenues. As expected, there are no changes to personal income tax, but the budget proposes measures to ease compliance and cut down on litigation, like more time to revise tax returns without penalties. Also proposes lowering tax collected at source on foreign travel to a flat 2%, TCS on money sent abroad for education or medical expenses to be also cut to 2%. The Finance Minister moves to further curtail any improper use of buybacks, proposes to tax buyback for all types of shareholders as capital gains, also proposes introducing an additional buyback tax on promoters to disincentivize the misuse of tax arbitrage. Says the tax will make the effective tax rate 22% for corporate promoters and 30% for non-corporate promoters. All right, a modest capex hike, more firepower for India's defence arsenal and a tax shocker for the stock markets. Finance Minister Nirmala Sitharaman's ninth consecutive budget is aimed at providing a thrust to manufacturing and offset the impact of the 50% US tariffs. Let's quickly take you through the top highlights. First, the stock markets were rattled after the Finance Minister proposed hiking securities transaction taxes on equity futures and options contracts. The market saw its biggest budget day fall in 6 years. The Finance Minister also added more firepower to India's defence arsenal. Defence allocation has been hiked by 21% to 5.9 lakh crores. Overall capex saw a modest growth of 9%. As expected, there are no changes to personal income tax, but the budget proposed measures to ease compliance and cut down on litigation, like more time to revise tax returns without penalties. Here are the key snippets of the Finance Minister's 85-minute long budget speech.
I propose to raise the STT on futures to 0.05% from the present 0.02%. STT on options premium and exercise of options are both proposed to be raised to 0.15% from the present rate of 0.1% and 0.125% respectively. I propose interventions in 6 areas. 1. Scaling up manufacturing in 7 strategic and frontier sectors. 2. Rejuvenating legacy industrial sectors. 3. Creating champion MSMEs. 4. Delivering a powerful push for infrastructure. 5. Ensuring long-term security and stability. And 6. Developing city economic regions.
ये बजट भारत की वैश्विक भूमिका को नए सिरे से सशक्त करता है। भारत के 140 करोड़ नागरिक फास्टेस्ट ग्रोइंग इकोनॉमी बनकर ही संतुष्ट नहीं है। हम जल्द से जल्द दुनिया की तीसरी सबसे बड़ी अर्थव्यवस्था बनना चाहते हैं।
Well, the budget also announced a slew of tax changes. Sonal Bhutra is here with more.
Basically, if you're going abroad to study for medical purposes or for leisure travel, you will have to deduct less TCS on the amount that you're paying there. It has been reduced from 5 to 2% for education and medical purposes, and reduced from 5 and 20% to 2% if you are taking a group package for traveling abroad. Of course, this amount can be set off while you're filing your return, but it created liquidity issues for investors or individuals, and that is something which seems to be getting solved by this particular change. On sovereign gold bonds, now remember, after the rally that we saw in gold, a lot of people were buying sovereign gold bonds in secondary market. There is a clarification which has come in that from April 2026, the gains on this will not be exempt from capital gains tax. Only people who have bought it from the primary market from the start to the end will not have to pay capital gains tax, but if you bought it from the secondary market, there will be no exemption that will be available. Now, the fifth one is that if you are paying interest, basically borrowing money to buy mutual funds, this interest that you pay will not be allowed as a deduction from any of the dividends that you are earning from mutual funds. So this provision is done away with. There are a lot of relaxations in terms of compliances as well for return filing. Let's now talk about the 6-month foreign asset disclosure scheme for 2 categories. First is those who have not disclosed the foreign income or assets, and those who have actually disclosed it, but they have not declared the asset which was acquired. So there are some provisions for that as well. Now let's talk about the corporate taxes, because there are changes in safe harbor rules, because this was a long ask from the industry as well. The threshold for availing safe harbor rules for the IT industry has been increased from 300 crore rupees to 2,000 crore rupees. So that's a positive which has come by. There are some exemptions on data centers as well. There is also exemption for income for a period of 5 years to any non-resident who is providing capital goods, equipment or tooling in a bonded zone. So basically the Make in India factor is working in case of a lot of tax exemptions which have been provided to some of these industries. The last one is now MAT, the minimum alternate tax is proposed to be made final tax. No further credit accumulation from 1st April of 2026, and the rate has been reduced from 15% to 14%. The brought forward MAT credit that is available in your books as on 31st March 2026 will be available to set it off against any other liabilities that you have. But these are some of the major changes which have been announced in the budget this time around.
Right, thank you Sonal for that. Shifting focus now, the budget also announced an initiative aimed at positioning India as a global biopharma hub with a proposed outlay of 10,000 crore rupees over 5 years. The Finance Minister also announced a slew of measures to boost medical tourism. Ekta Batra is standing by with the details. Ekta.
Well, yes, I'll start with, biopharma Shakti, which was announced. So it's around a 10,000 crore biopharma scheme which was launched, which is aimed to make India a biopharma hub, build domestic biologics manufacturing. So there are 3 new NIPER institutes which are planned, 7 existing NIPER institutes which will be upgraded, and 1,000 plus accredited clinical trial sites which are proposed as well. It is a sentiment positive for the sector. Biocon, Dr. Reddy, Sun Pharma, Lupin, Glenmark, just to name a few. In terms of hospitals and diagnostics, medical tourism push, so 5 regional medical hubs are planned. It will be a public-private partnership model. Integrated healthcare complexes are proposed as well. Listed beneficiaries include the likes of Apollo, Fortis, Max Healthcare, Dr. Lal's, Metropolis, all of these stocks in focus. But remember, while this is a positive, the execution will be something that the street will be watching for in terms of all of these announcements and the material impact eventually on the earnings as well.
All right, thank you, Ekta. Now, the budget also proposed hiking defence capex outlay by 21% to 5.9 lakh crore rupees. Ria Bhatia has more. Ria.
Well, yes, the government this time around has announced a total defence budget of 7.85 lakh crores. Now, compare this to last year's budget of 6.81 lakh crores. It's an increase of roughly 15%. So, the expectations on this front range from 10 to 15%. So, this is at the top end of the expectations. The defence expenditure has been announced at 5.95 lakh crore rupees for the year, up 21% compared to last year's budget. Defence capital allocation has also been announced at 2.31 lakh crores versus 1.92 lakh crores in FY26, and this is also an increase of roughly 20% compared to last year, also in line with the expectations that the street was working with. There has also been a 24% increase in the budget for defence modernisation, which is a big positive. Apart from this, they have also allocated roughly rupees 63,734 crores for aircraft and aero engines for defence, which is a 31% increase compared to last year's outlay. Now, in terms of the market reaction, the Nifty Defence Index ended roughly 5.4% lower today, recovering from its lows of 7 to 8%. And in fact, at one point of the trading session earlier before the budget was announced, it was up by roughly 2% earlier in the session. Now, the street seems to be disappointed by the fact that there were no separate announcements or schemes that were announced for certain segments like drones, UAVs, electronic warfare, defense electronics, missiles, even for arms and ammunition or for indigenization as a whole. So that is where the street seems to be disappointed. But overall, this was a very healthy increase in the capital allocation as well as for the overall defense budget.
ऑपरेशन सिंदूर की ऐतिहासिक सफलता के बाद आए इस बजट ने देश की रक्षा व्यवस्था को और मजबूत बनाने की हमारे संकल्प को सुदृढ़ किया है। यह आवंटन पिछले वर्ष की तुलना में 15% से भी अधिक है, यानी इस बार भी केंद्रीय बजट का सबसे बड़ा हिस्सा रक्षा मंत्रालय को मिला है।
All right, so what did the budget have for the startup ecosystem? My colleague Shruti is joining us on the broadcast. Shruti, over to you.
Well, thanks for that. Budget 2026 sends a clear signal to India's startup ecosystem. This is no longer just about creating startups, it's about helping them scale. Here are the key takeaways. First, deep tech and manufacturing. The launch of India's Semiconductor Mission 2.0 is a major push for hardware, chip design and advanced manufacturing startups. The focus is on building full-stack domestic capabilities, from equipment and materials to design and supply chains. This is backed by a 40,000 crore rupee allocation for electronic components aimed at easing supply bottlenecks. Alongside this, the development of critical mineral and rare earth value chains brings deep tech startups in electronics, EVs, defense, and clean energy into focus. Second takeaway is growth capital for MSMEs and scaling startups. The government has announced a 10,000 crore rupee SME growth fund, along with a 2,000 crore rupee top-up to the Self-Reliant India Fund. The emphasis is on patient capital to help small businesses and startups scale. Liquidity support through mechanisms like TREDS and credit guarantees is expected to ease cash flow pressures. Third, easing operational friction. Budget 2026 addresses a key pain point with the rollout of corporate mitras in Tier 2 and Tier 3 cities, aimed at providing affordable compliance and professional support, helping startups scale beyond metros. Fourth is women-led entrepreneurship. The proposal to set up self-help entrepreneurs or she-marts is a significant step. These community-owned retail outlets are designed to help women move from credit-linked livelihoods to enterprise ownership. And finally, AI and innovation. Fresh allocations for AI capacity, building missions, and the operationalization of the Anusandhan National Research Fund underline a push towards indigenous research, workforce readiness, and long-term innovation, critical enablers for India's startup ecosystem. Overall, Budget 2026 lays out a clear framework, capital support, manufacturing depth, and technology capability. The real test now will be execution. Back to you.
Right, thank you, Shruti, for that. The budget also saw a slew of initiatives to boost the textile and seafood industries. So, will these measures help offset the impact of America's tariffs? Shilpa Ranipeta has more. Shilpa.
Well, that's the hope. But let's look at what the announcements were. Now, the government has announced a series of relief measures for India's textile, leather and seafood industries. All labor-intensive sectors, all currently under pressure due to high US tariffs and weak global demand. Now, starting with seafood. Now, seafood, the duty-free import limit for inputs used in seafood processing, that's been raised from 1% to 3% of last year's export value. This means that exporters can now import more essential materials without paying customs duty, helping them cut costs. Now, in another big move, fish caught by Indian vessels in India's EEZ and on high seas will now be duty-free. And if that fish is landed at a foreign port, that will be treated as an export, allowing fishermen and companies to legally sell abroad and access export benefits. Now, the government also says that safeguards will be put in place to prevent misuse of this. Next, leather and footwear exporters. Now, the duty-free import benefit, earlier available only for full footwear exports, has now also been extended to the shoe upper exports. That's the upper layer of the shoe as well. And this lowers costs for a key segment of the supply chain. Also, exporters of leather goods, garments and footwear will now get 1 full year to ship their products, up from earlier 6-month deadline, and that gives them more breathing room as orders slow down amid delays because of the entire tariff situation. Now, on the textile front, the government has announced an integrated push. This includes new schemes covering fiber, self-reliance, cluster modernization, job creation, handlooms and handicrafts, sustainable textiles, and a lot more, including mega textile parks and a new initiative that aims to strengthen khadi, handloom, and village industries. Now, with a focus on branded training and global market access is also there. Now, why this support now? Because US tariff shock has been hitting these sectors hard. The US accounts for nearly 30% of India's apparel and textile exports, and these after a 50% tariff, have been in a difficult place, especially places like Tirupur. They have been warning of factory shutdowns as shipments to the US have fallen by over 50% in Q3. CRISIL, in fact, has also said that it expects the US tariffs to result in India's leather industry's revenue falling by about 10 to 12% in FY26. And in the seafood industry, US makes up about 35% of exports, and shipments have already fallen 25%, with new orders in the future completely drying up. In short, the government is trying to ease costs, extend timelines, and protect jobs as export-heavy sectors navigate one of their toughest global trade environments in years. Back to you.
Right, thank you, Shilpa. Now, Budget 2026 has also proposed a 20-year tax holiday to any foreign company that provides cloud services using data centers in India. Rachna Dhanrajani is here with the details. The government giving tax incentives. Rachna, over to you.
That's right. Budget 2026 puts data centers firmly in focus with clear tax incentives aimed at pulling global cloud companies into India. The Finance Minister has announced a tax holiday till 2047 for foreign companies offering global cloud services from data centers located in India. Any services sold to Indian businesses, however, will be routed through an Indian reseller and they will be taxed locally. But to reduce tax uncertainty, the government has fixed a 15% safe harbor margin for related party data center services. This is a move aimed at cutting long-running transfer pricing disputes for global cloud firms. But there's also a supply chain push. Non-residents warehousing electronic components in bonded warehouses will be taxed on a 2% profit margin, translating into an effective tax of about 0.7%. So who benefits globally? Well, large cloud providers running global workloads from India stand to gain definitely. This includes Amazon Web Services, Microsoft Azure, and Google Cloud. Now, global electronics manufacturers using bonded warehousing in India also benefit, as do the multinational tech firms looking for long-term tax certainty till 2047. On the Indian side, however, several companies are positioned as key partners given that they have a joint venture. First up is Adani Enterprises, who's in a joint venture with Edge Connex under Adani Connex. There's Reliance Industries, who's building large hyperscale data centers, campuses in partnership with Brookfield and Digital Realty. Then there's Bharti Airtel. Through Nextra Data, this works with global cloud and enterprise clients. Then there's also Tata Communications that's providing data centers and cloud infrastructure to global enterprises while being located in India. And then there's ST Telemedia Global Data Centers that runs a large India presence and is backed by the parent company that also has ownership from KKR. So put together, these measures show how the budget is using tax certainty, lower logistics costs and clear rules to position India as a base for global cloud and data center operations. Back to you.
Right. Thank you, Rachna, for that. Commerce Minister Piyush Goyal is in conversation with Parikshit Luthra. Let's cut across.
Safeguarding Indian exports amid global uncertainties was a key theme of the Union Budget 2026. Joining us right now is Union Commerce Minister Piyush Goyal. Minister Goyal, thank you very much for joining us. You're just emerging from successfully concluding talks with the European Union. How does the FTA push that we see from the Commerce Ministry and now the Union Budget complement each other in supporting India's export story?
Well, I think this is a fabulous budget. It's a budget which reflects a future-ready Bharat. It takes forward Honorable Prime Minister's Reform Express full stream ahead, covers a very wide span of businesses and sections of society, women, youth, MSMEs, the manufacturing sector, equally the services sector. Technology has been given a big thrust. We see education and skilling getting a focused attention. So much so that a new National Institute of Design has also been proposed to be set up. Inland waterways being expanded, 7 high-speed rail corridors coming up, 12,20,000 crores being invested in infrastructure. And the speed at which we are developing infrastructure has become a surprise for the entire world today. If one looks carefully at this budget, it's very holistic, very forward-looking, preparing 140 crore Indians to speed up our journey towards Viksit Bharat.
Let me ask you about one major measure that has been taken by the Commerce Ministry, and that is for SEZs, one-time relief for manufacturing units in SEZs to sell a limited portion of their output in domestic markets at concessional rates. This was important because of the strain on manufacturers right now. Could you give us the contours of this scheme?
Broadly, the idea is that existing units in SEZs are today required to pay duty as if the goods are being imported into India if they supply to the domestic market. Many of them have surplus capacities and the same goods are being imported duty-free from other geographies. The idea is that these existing units can use their surplus capacity and some proportion of their production, obviously less than what they are exporting, may be allowed to be sold in the domestic market in such manner that it doesn't hurt other domestic manufacturers. So we equalize or make a common level playing field for both by reducing the duty burden on the SEZ unit, but reduce it to such an extent that they are at the same level as other domestic manufacturers.
So what will be the duty level? What sectors
will it will depend on sector to sector. There would be some sectors where we may not give this benefit, things like refining crude, petrol and diesel. Probably there it may not be proper to allow this. It may be to a big disadvantage to the other refiners. So it will have to be seen sectorally, and we will have to calibrate the approach so that SEZs also benefit, SEZ units get an opportunity to serve Indian needs, and we save foreign exchange.
Right. There's been a lot of focus also on labor-intensive exports from India, textiles, leather, footwear, especially rationalizing customs duty on the import costs. give us a sense of the targeted measures that you've taken and the kind of sectors you want to support with the budget.
Well, if you look at the budget, it is looking at labor-intensive sectors, it is looking at technology-intensive sectors, it is looking at traditional sectors, it is looking at futuristic sectors. I mean, the expanse is phenomenal. Textiles. It adds new textile parks, mega parks. At the same time, the thrust is on man-made textiles, because 2/3 of global trade today is on man-made textiles. It gives a thrust to the leather industry and sports goods and sportswear and sports shoes. Idea being that there's a large market out there which we can service very well because we have low labor costs. Marine fishing, it opens up avenues in the EEZ so that we can expand our marine exports also. It will also help us provide nutritious foodstuff for our domestic consumption. Animal husbandry and poultry has also been given a thrust. So wherever there is farmer or animal husbandry or fishery involved, we continue to support them to increase their incomes. All labor-oriented sectors, and for that matter, infrastructure also is a highly labor-intensive sector, are being given a thrust. Look at the data centers. Duty tax-free until 2047, 22 years from now. Can you imagine the huge thrust that this will give foreign companies who wish to invest in India to set up data centers and provide cloud services internationally? And look at the benefits for India. We get the material, we get investment into India. We sell material for construction, provide jobs to people to set up these data centers in terms of the infrastructure required. It needs tons and lots of power and lots of power redundancy. So it will promote investment in energy sector. By and large, these data centers prefer renewable energy. So it will give a thrust for nuclear energy, for green hydrogen, green ammonia. It will give a thrust for solar, hydro, battery storage, pump storage. It opens up avenues in a very holistic way. All of which lead to jobs, all of it lead to investment, all of it lead to economic activity, taxes. So the budget, I find, is an economically and fundamentally very strong budget, which gives an impetus to our growth story.
Are there certain sectors which are going to get more relief in the coming days, maybe leather for that matter?
We are looking at a scheme which may help to promote the leather industry in a big way, and are trying to draw up the contours of that.
On services exports, there was a substantial amount of time spent by the finance minister on boosting the services industry, including the IT industry. How does this safeguard the interests of our services sector, services exports?
We have tried to simplify processes and improvise on the safe harbor rules on most of the services, also clubbing all the IT-related services into one. There's a committee going to be set up to look at the services sector holistically, because we find that's an area of strength of our country. It's an area where we are growing already very rapidly, and we see tremendous potential to increase our share in global trade and services to at least 10% of the global trade. And by the way, that is a big amount. Just the European Union alone, with which we've opened up 144 services subsectors through the free trade agreement, imports 2.7 or 2.8 trillion worth of services every year. Currently, we export only 46 billion. If we can target at 10% over there, we're looking at nearly a $270 to $300 billion services export to European Union. That's the potential. So I think this is a budget which meets the aspirations of New India, which meets the aspirations of Young India, which provides wings to the dreams of New India.
Speaking about the FTA with the European Union, give us a sense of how this is going to safeguard our export growth story, and what kind of growth numbers do you expect once this FTA comes into effect, and possibly even a timeline if you could share with us. Your colleague Your counterpart, Maros Sefcovic, said hopefully early next year.
Probably even earlier. Subsequent to that, we've had discussions at the highest level. We are looking at speeding up the legal scrub. We are looking at using artificial intelligence to get us the first cut of the 24 languages it needs to be translated into. And then, of course, the human beings can look at it. We are looking at the European Parliament fast-tracking approval, particularly since this is one agreement where no sensitive sector has been touched. So unlike the other agreement, Mercosur agreement, which from 19 to 26 took 6 years to approve, in this sector, all the 27 member states have welcomed it and are actually requesting that this should be fast-tracked. The German Chancellor yesterday said that this agreement, the India FTA, should be fast-tracked and implemented at the earliest.
So how much do you expect it to add to our growth story?
Our guess estimate or first cut estimate, both on the European side and Indian side, reflects that we should be able to double our bilateral trade in the next 5 to 6 years after it comes into effect.
What about the situation with the United States? Are there certain differences right now in trade talks? Have some new issues come up? Any sense on the timeline?
You heard the Honorable President of the United States of America this morning about Air Force One. And I think we are making good progress and working in the spirit of friendship.
Right. Just a word on what Jamieson Greer had to say. Just last year, he had said that India has given the best possible deal ever. Now, in his latest remarks, he said that India needs to do more when it comes to reducing Russian oil purchase. I can assure you we are in regular touch. My good friend Jamieson and I, we've known each other since Trump won. And I have absolutely no doubt that between him and me or between both our teams, the synergy is very good. The understanding is very positive. And we'll be able to finalize very quickly. So would it be a matter of a few weeks or months?
That we will have to wait and see. You know, we never do any trade deal with deadlines.
To what extent have you tried to address global uncertainties, the trade volatility with the US in the budget to safeguard India's interests?
I think this is a budget for the next 25 years. This is a budget for the future of India. It's a budget which prepares India to take rapid strides towards Viksit Bharat 2047. So I don't think the budget is ever formulated based on just a particular situation or a particular uncertainty. Budgets are always made for a long-term vision of the country.
Right. On quality control orders, you've done a lot in terms of eliminating QCOs. The survey said that more can be done. Are we looking at a greater review of QCOs?
It'll be a calibrated approach. If we find that the QCO can be deferred or might be even eliminated and that it is, we already are producing good quality production in India and even the imports into India are of good quality. We are not getting substandard goods. We will always be open to amending or even eliminating QCOs. Right. We are a listening government. This government is open to inputs and open to ideas. At the same time, we have to make sure that vested interests may not try to once again bring in substandard quality production in India. As you're aware, the Honorable Prime Minister has focused very strongly on quality since 2014, when he introduced the concept of zero effect, zero defect, Z. He spoke about it in his Mann Ki Baat last Sunday. He spoke about it on the first day of Parliament. He spoke about it today when reflecting on the budget. So I think this is very dear to the Honorable Prime Minister. It's very important when India plans to become a developed nation to also focus on quality in a big way.
Right. What is the message that you'd like to send out to global investors with the budget, sir? FI outflows have been a concern. It's been about $23 billion. The drop in FDI has been questioned by experts as well. So what do you think is the message that India is trying to send out with this budget to both domestic investors and global investors?
Well, I think being the fastest growing large economy with fiscal prudence at the core of our thinking, you can continue to see fiscal consolidation in this budget also. With the fact that massive investments are going into infrastructure, and new opportunities are being created for investments in manufacturing and promoting services. We have set the roadmap for the next 2 decades, powering the economy on towards Viksit Bharat, a developed and prosperous India by 2047. I think those who will miss the bus today will regret it.
Any rethink on the press note 3 on China?
We have been receiving requests from many quarters that there could be a de minimis so that the larger funds, which may have a very small element of some 1 or 2 Chinese investors having 1 or 2, 5% Chinese investment in a larger pooled capital or a fund, may be considered for exemption, because that's not really an opportunistic takeover that could be planned. It's just a financial investment which comes in through the form of funds. It is certainly something which has been brought to our notice and is under consideration.
Minister Goyal, thank you very much for joining us to give us the sum and substance of the union budget and the message it sends out to our exporters and the global investor community. Thank you so much.
Parikshit.
Thank you. I'll just do a quick Hindi one.
All right. Thank you, Parikshit, for that conversation with the Commerce Minister. On that note, what we'll do is we'll take a short break, but don't go away. News and updates continue right here on CNBC TV 18.
Finance Minister Nirmala Sitharaman has delivered the budget 2026 with an eye on resilience, with an eye on future technologies, with an eye on ease of compliance. Also, we've seen a high capex allocation for infrastructure and the defense. These are all-time high allocations that we're looking at. Joining us right now to break down the budget maths is Cyril Shroff, Chair of the FICCI Corporate Governance and Corporate Laws Committee and Managing Partner Cyril Amarchand Mangaldas. We also have Nirmal Jain, Chair of the FICCI NBFC Committee and Founder IFL Group and Managing Director IFL. We're also joined by Rashesh Shah, Past President FICCI and Chairman Edelweiss Group. Thank you very much, gentlemen, for joining us. Mr. Shroff, how do you think this budget delivers in terms of making India more attractive for a place which can attract durable FDI and foreign institutional investors?
So, whilst this is not a big bang budget in that sense, there are a lot of solid pieces in it. And when you look at it in the context of continuity of number of policies that were announced in the last 2 years and see this as a continuum, there is a lot of good stuff there. And there are a lot of hidden gems also inside the budget as well. So I think it has got a lot of solidity in it in terms of infrastructure, defense, financial services as well. There's a new committee that has been announced. So I think the overall impact in terms of driving growth creating stability, especially in this very uncertain geopolitical environment. It has got a lot of solid pieces about it, and I am quite hopeful. One should not get influenced by some temporary reactions on a Sunday from the stock market. I think it will take a couple of days for it to settle. But I'm quite hopeful, and I think that there are significant pieces of reform that have been put in, including, say, for example, on technology, data centers. These are not insignificant at all. So I'll stop there.
Absolutely. Absolutely. Let me also get in Nirmal Jain at this point. Mr. Jain, we saw the Finance Minister announcing a high-level committee on the banking sector. This was to suggest recommendations for a Viksit Bharat. How do you see the developments, announcements in the union budget from the purview of the NBFC sector?
I think it's a very significant development because government is committed to make sure that our financial sector comes to the global level. I mean, it becomes the world class. And if you really look at it, Indian banks' asset quality has been best in, if you compare with any other country, even developed countries, is far better. And coming to NBFC, to your specific question, if you would have noted in last 1 year, I think Finance Minister as well as the RBI, they recognize that NBFCs are essentially complement the work being done by banks because India is a very vast country and there are large sections of population and geographies which are unbanked and underbanked, and they need to be done in a manner which is cost effective and also certain skill set which NBFCs develop for underwriting in niche segments. And I think the new co-lending guidelines are also an impetus to banks and NBFCs working together. So for Viksit Bharat, I don't have any doubt that banks and NBFCs are, they complement and they'll have to work together, and there's a lot of work to be done. And I think that policymakers also recognize that.
Right. Let me go across to Mr. Rashesh Shah. Mr. Shah, how do you see announcements in the union budget? Let me begin by what's happened at Gift City. The tax holiday period has been increased from 10 years to 20 years. We've also seen the investment limit for PROIs being increased. So how do the budget announcements augur well for the stock markets, for the mutual fund sector?
See, overall, I think, as you said, Gift City is a very important, institution in India because it is the hub where capital will flow into India and capital will flow out of India. We have Indian capital which also needs to be invested outside. There's a lot of outward FDI now happening. We have international capital which will keep on coming to India, and the Gift City will become a hub. So I think this growth of the Gift City as an institution which is part of Indian economy and part of Indian capital market is actually very important, and I'm very happy to see all the announcements on that. But I think overall, if you see a lot of the focus, as we spoke earlier, it has a lot of small things for a wide sector of the economy, which is a good thing. There is no one big bang. It's more business as usual on the fiscal consolidation, everything else. The one thing that I'm very encouraged by is the bond market. The entire credit flow in the economy needs to be smoothened out. Because for an economy to do well, we need equity flow and credit flow. Equity flow has been going very well. We had almost 8 lakh crore from household savings coming into equity markets onshore in the last year. We need credit market from banks, NBFCs, AIFs, InvITs, REITs, bond market, all of that to start coming of age also, the way our equity markets are there. So I think the announcements on that, the focus on that, including state bonds and municipal bonds, all these are good ones. I'm actually pretty encouraged by that.
Right. Do you feel, even though there was a lot of expectation on STT and LTCG, that has not happened? STT has been hiked marginally. Would you call that a dampener?
Yeah, I think the market is not prepared for that. And you know how the stock market is, it always has a knee-jerk reaction. And I think every year it happens that, people build expectation. There are rumors on the WhatsApp that they're going to cut because the market has been more consolidating. It's not been a market that has been going up. So a lot of the equity market thought it is very important for the government that the equity markets go up. So there will be some immediate short-term reforms. But that is not how government, actually the entire process works. I think STT on FNO is, to me, it is a non-issue for the equity markets as a whole, because we have seen last couple of years the rampant growth in FNO has also been a concerning area for Reserve Bank, for SEBI, for government. So we should expect that curbing FNO will be an ongoing effort, increasing cost in FNO will be an ongoing effort. I don't think the equity markets do get affected by what happens in the FNO market. The equity markets currently are waiting for growth. And I think corporate earnings growth, corporate capex, credit growth to pick up, all those are the real growth indicators that we would want to look at. And only when that starts, I hope that some growth has started in the last quarter, green shoots have happened. I think we are maybe a couple of quarters away from corporate earnings growth becoming really visible to all of us. And when that happens, I think the equity markets will start becoming optimistic again.
Okay, let me now go back to Mr. Cyril Shroff. Mr. Shroff, we have always seen that India has not been able to significantly increase manufacturing as a share of GDP. How does this budget do in terms of increasing India's manufacturing capacity, increasing our manufacturing exports to the world, investments in key areas such as electronic components, biopharma, container manufacturing, and even rare earths? So how does this do in terms of increasing manufacturing as a percentage of GDP, and also manufacturing of critical components, including rare earth, in India?
No, absolutely. And I think your question kind of answers itself in terms of the focus on all these sectors, whether it's on biopharma, biologics, rare earths. I think this continues a pre-existing theme of focusing on manufacturing, and this is what India needs for creating jobs. But the other thing which might have been missed out in terms of the narrative is services. I think this is also a very big services budget in terms of tourism, in terms of medical tourism, in terms of education, the six university centers that have been created. So you add all of that, I think it's a good balance between manufacturing and services as well. In fact, I thought the services exposure was even more so as well, which will create both jobs and prosperity. So I think it has been a very smart move in terms of balancing both. So manufacturing is a pre-existing theme, and it got stronger with a special focus. But the new addition at scale is is services.
Right. Do you feel that the kind of announcements we've seen on services, that is going to really complement the FTAs that will come into effect this year? EFTA is already in effect. We will see the UK and the European Union FTAs coming into effect later this year, early next year. So combined with the FTA push and the push for services, do you think services exports could see a good increase in calendar year 2027?
I think so, because I think we've moved away, thanks to everything that's happening outside, from a multilateral system, and it's now, I think India has also chosen to have many FTAs individually with major economies as well. So I think that is the modus operandi that India has chosen, and it's quite powerful. I think services will be a very important part of it. So for example, let's take the EU, which has been recently signed. I think the services and movement of personnel is going to be a very big part of it, and I think it's going to help both markets significantly after we go through the process. So I think that's a big one.
one theme that everybody was looking out for was resilience amid turbulent times. And that's what Nirmala Sitharaman also referred to, that we're looking at a lot of global volatility. And therefore, the concentration, the emphasis on manufacturing and also customs duty reduction, an extension of customs duty exemption on several critical areas, including capital goods in certain sectors. How do you see that push? And do you think this focus on exports and FTAs while rejigging customs duties, extending customs duty exemptions, that's going to help the export growth?
Yeah, these are very positive steps. And at this point in time, India needs to narrow the trade deficit and focus on currency. So, and also capital goods and infrastructure, they always need support. They will create jobs, they will create long-term growth, they will sustain long-term growth. And I think there's a very welcome focus on semiconductors, for which 40,000 crore rupees have been allocated, the 20,000 crores for carbon-free and tourism. So these are very positive steps from the economy's point of view. I think, and as you said, customs duty exemption time extension, I mean, this is also very positive, very welcome, and was expected by the industry. So from the manufacturing point of view, although see, today manufacturing contributes relatively small part of the economy. So I think 2/3 of the economy is now services, and manufacturing is just about 1/6. But it's still important to create jobs, that is one. And more importantly, we really can't compete in manufacturing of the traditional goods like, say, durables or, the household things. But the manufacturing focus now has to shift to semiconductors and also services as important, including tourism, data center. So all these policy initiatives are, I think, they are steps in the right direction, and they will help the economic growth to sustain. As you know that we are the fastest growing economy among the large economies in the world. And I think in that sweet spot, we need these kind of impetus to sustain the growth and also the jobs.
Right. Mr. Rashesh Shah, we've seen how the market's sentiment over the last few months, as a result of not having certainty or clarity over the US trade deal, that has been a little low. The sentiment has been a little low. Do you think this budget addresses certain fundamentals of the economy very well, which will perhaps maybe nullify or address the sentiment, maybe not today, but over the next few months?
I would think so. In India, there are 1,000 things to do because we are a very broad, very complex, very heterogeneous economy. So we need to do things on manufacturing, on services, on agriculture. We need to do things for MSME, for exporters, in the new age economy, data center, AI investment. So India, there are so many needs and so much to be done, like in the bond market, municipal bond, state bond. So I think the FM has picked as wide a range of things that she can do that is possible, and actually done incremental improvement, ensured that the right focus is given to the right for MSMEs, for exporters, for everybody. So in a way, it's a very broad swath of things that she has attempted to do and announce in this, which is in a way a good thing. It's very balanced in that sense. There is no hyper focus on only one particular part of the economy because we can't afford that. We are not a small Asian country which can do only exports and do well, and you can only focus on export sector and do well. We have to do hundreds of things for the economy to really go along in a balanced manner. And I think that is what she has achieved. I do think that honestly, having seen how the actual policy making works, I don't think the immediate need for them is to have a stock market on steroids or to say, what can we do in the budget to make the stock market feel good? I think the stock market is an animal by itself. There are knee-jerk reaction. It's also Sunday where a lot of the institutional investors are not very active. So the real impact on how the stock market assesses the impact of this on the economy as a whole, on the growth as a whole, on not just on the stock market itself, will take at least another couple of weeks. And that is how it has been. So we'll all read, we'll study, we'll speak to our clients and see how it impacts them. But I do think on the whole, from what we see now, she has tried a wide swath of things to do to make sure there was enough focus on everything.
Right. Let me go across to Mr. Nirmal Jain. Mr. Jain, in terms of ease of banking, ease of doing business, we've seen how many of the prosecutions and penalties related to taxation, they've either been combined together or they have been reduced or scrapped. How do you see these moves from a point of view of investor confidence?
No, they are very positive steps, and I think the intent and efforts have been in the right direction over the last few years. But what this government has inherited and the legacy of the tax structure that has evolved over the last 7-8 decades is fairly complex and a long way to go still. And I'm sure Mr. Sroff probably is a practitioner and can comment more on this. But there are many steps taken, and there's an intent which is absolutely in the right direction, that we need to remove prosecution, we need to do a lot of things to make sure that there's ease of doing business. And in fact, the business has become a lot easier in the last 10, 12 years. There's no doubt about it. But if we compare with global peers, we compare with the best in the world, then there's still a long way to go.
Right. Mr. Shah, one point that we missed was about the defense sector. Highest ever allocation, 21% increase in overall capex, 24% allocated for defense modernization. I saw almost a 30% increase in allocation for defense aero engines and aircraft engines as well. So possibly we're going to look at some big orders in this calendar year and next financial year as well. But how do you see this major push for the defense sector, and how will this translate into the performance of defense stocks, PSUs, some of our major defense listed companies in the private sector over the next few years?
Yeah.
The reasons...
Good.
Sorry. The reasons for this allocation, I think, is obvious. We had Operation Sindoor last year, and I think we are living in a very uncertain world. So I think the short answer to your question on how do you see the impact of this on defense stocks and just the defense industry, I think the answer is very positive. It was a need of the hour. Just the entire security environment around the world is becoming fairly uncertain, and we have no choice but to be Atmanirbhar. But Rasesh Bhai, over to you.
No, I was just going to add that absolutely it was expected, because the way all the things in the world are, the way the geopolitics is after Operation Sindoor, so this was expected. I don't think the Indian defense industry currently is starved for business. I think there is a lot of business, more business will come. In fact, I believe that India will become an exporter of arms and armament in the next 5 to 10 years. I think it is moving at a fairly rapid pace, and every government in the world is actually arming itself up, and there'll be all kinds of equipment that India can make where we can cater to the world at large. So I do think defense is a big theme for a lot of investors. That will continue to be. The budget has only highlighted that, has only underscored that. But I think whether it's defense or whether it's MSME or services, I think the one big focus required, as Nirmal was saying, was ease of doing business. But it's not just the central government or the finance minister can do that. Ease of doing business is all the ministries in the government. Ease of doing business is also at the state government level, at the municipal level. And that is one thing. I mean, reducing bureaucracy, reducing regulation, that will be a big impact. The government has set up a commission to deregulate. I think if that can move fast enough, that will have a very, very deep impact, even beyond anything else, on the economic growth.
All right, we've run out of time, but thank you very much, Mr. Rasesh Shah, Mr. Nirmal Jain, and Cyril Shroff for joining us with your outlook on Budget 2026 and how this will impact the financial sector, the stock markets, infrastructure, and investor mood towards India.
Well, you've heard many big voices, but I think the biggest among them all is the country's biggest banker. Joining me now is Mr. C.S. Sethi, Chairman, State Bank of India. Mr. Sethi, thank you very much. You've had some time to ruminate over the budget. It has been put forth as a services budget and as one to encourage manufacturing. Are you more confident about your credit growth after looking at it, more confident of the rate of growth of GDP after listening to the budget?
Absolutely, Lata. First of all, thank you very much for having me on your show. I think this budget, I've been, off and on listening to the conversations on your channel. I think most of you have brought out the essence of this budget, and it was very clearly presented by several people that is services and manufacturing, which are focus areas, and rightly so. And services, both in terms of contributing to the domestic economy as well as contributing to the exports, have been playing a very significant role. And manufacturing, both from the Atmanirbhar point of view as well as job creation point of view. I think this manufacturing also has been very critical. So these two are critically focused in the budget. And what we have seen is that overall, as we have given the guidance earlier also, there have been an uptick on the corporate credit. And I assume that the announcements, the next fiscal also will contribute to significant addition in the credit growth, both in terms of the large corporate, because most of the sunrise sectors which have been focused attract capital from the large corporates. And the projects will be mostly taken up by them. And MSME, growth fund and micro fund, which have been announced, would spur the growth of MSME credit too.
Okay. No, there's no taking away from the fact that the government has touched all the right sectors which need a push, even the advanced cutting edge ones and the bottom of the pyramid where vulnerability is high. There's no taking away from that. So, but there is, there are those small fears, or some of them even large. For instance, cost of credit, 17.2 trillion gross borrowing, the market was not prepared for that. My poll threw up 16.2 trillion as a likely expectation. Some went up to 16.5, but 17.2 is an outlier number. That will push the cost of credit for everyone. Is that a worry?
So my information from my team says that we need to wait for the buyback, which is outside the budget announcement. If you see last year also, we almost had 80,000 crores buyback, which is outside the budget announcement. So I think the number need to be adjusted for potential buybacks, and that could be a modest number. And the another thing, what we have also seen that most of the numbers, both on the revenue side and as also the borrowing side, seem to be conservative. That means on the revenue side, the estimates seem to be conservative. On the borrowing side, on the higher side, the conservatism is shown. So the uptick is also coming from the T-bill. And we have seen many a time T-bill announcements are made, but T-bill was not actually utilized. So it is too early. I think let us digest these numbers and also hear from the policymakers tomorrow. I think most of them will come back onto the public forum, and we will hear more details on them. I'm not rushing towards any conclusion in terms of either yields moving up or in terms of the crowding out impact of the public debt.
No, you're absolutely right, sir. It's quite possible on February 6th, the RBI comes and says that they're going to be more generous with OMOs, or, they could even announce, as you say, about switches and buybacks. That is there. But as of now, the few bond market participants who came on the channel are expecting yields to go up by about 5 basis points tomorrow from 6.7 to 6.7.
Yes, in the near term, till we get the clarity, probably there would be some moment on the yield side. Yes.
Would you worry, therefore, that Q4 results can be kind of burnt by, frayed by, mark-to-market losses?
I don't think so. I don't think so, unless there is a very high unusual moment in the bond yields.
Okay.
If it is only 4 to 5 basis points, what you are mentioning, the bond experts are mentioning, there need not be any real worry on the MTM losses.
Okay. I want to ask you about the mother of all questions, the banking committee. But before that, a word on the rupee. Because of the incessant fall, there were expectations that the FPIs would be given some let-off on taxes. There were various things expected. What has come are for data centers. That doesn't come today. That's a longer-term thing. So would you worry about the currency?
So the near term, there could be some additional pressure on rupee, but we believe that as you mentioned again, a lot of measures, starting with your permanent residents outside India,
yes,
to the various fiscal incentives which are given for the infrastructure investments by data centers and all, would attract, I think, the flows. They are medium to long term. That also, the outlook for the rupee shifts from completely negative to neutral to positive, in my view.
Fair point. Sir, now that big question. The banking committee, it's called a high-level committee. So what are you expecting? That the PSU banking law, what is it called? Nationalization and Takeover of Banking Companies Act, under which banks were nationalized, that itself will be recast? Are you, is it a big, brave thing that you can expect from this recast in terms of ownership, control, etc.?
So currently we have no clue what exactly this high-level committee is going to look at. But if I read from the FM's announcement, it was mainly in terms of preparing the banking sector, predominantly the public banking sector, of course, is for next. Today, if you see the robustness of public sector banks, both in terms of the profitability or in terms of the asset quality, calls for, how do we prepare the next stage of the public sector banks, without losing the focus on the customer protection, financial inclusion, and stability. And I think somewhere she also mentioned in terms of technology development in the public sector banks. My view is that it would be more in terms of the structural reforms encompassing some of these areas. I don't know whether this committee also will look into mergers, the potential consolidation in the public sector banks. I think we need to wait for the terms of reference, Lata. I think it's too early to rush into,
No, I agree with you. We don't have the terms of reference. We don't have the members of the committee. But I'm sure whoever are the members, you will be one of the persons called in terms of consultation and Q&A by that group. We will touch base with you on that issue sometime later. Thank you very much, Mr. Sethi, for sparing time for us today.
Thank you, Lata. Thank you.
Okay, now with that, let's go across to Shireen Bhan, who has one of the biggest and most important ministers, Ashwini Vaishnav, with her.
The prioritization of AI, of IT services, of global capability centers. I mean, never before have we heard of a 22-year tax holiday. In fact, most people believe it's too good to be